Hello everyone, it's Hiền Nguyễn from ST Consulting. So today I'm going into a brand new topic. So the two things Warren Buffett does in every investment decision that helps him to make money and become one of the best investor of all time. The first thing is that he, in every deal, in every investment, in every decision making, before he looks at the stock price in the market. This is the first step he does. He always look and study the company and analyze its intrinsic value first. Okay, so this is a video where one of the interview he said about it, and he has said this in many interviews, in many videos interviews, and also personal interviews and meetings. He always mentioned this principle. You have to analyze, do the valuation for the company before you go to look into the price. Okay.
I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
So now I'm going to take you step by step how he does it. So you know that there are many methodologies to analyze and to get the intrinsic value of the company. Okay, these are the three most normal and very common ways of doing analyzing and doing valuation for a company to get intrinsic value. The first one is the cash flow. Many people do that. The second one is to analyze the multiples of the company and also the industries to get the valuation. The third one is to analyze and to value the assets of the company. So these are the three common methodologies that people use in the market to get the intrinsic value of the company. There are many other methodologies for different industries, different sectors. You may use some other more common methodologies for those sectors. Okay, so you have startup, you may have another way to do it that cannot be based on earnings and on the revenues or the valuation for the company. So you need to find another way for the startup, for example. However, in this step I'm going to show you is something that Warren Buffett almost always favor since he's starting off his investment life. That is something about the valuation that his dearly teacher, okay, Graham had created and share with us. Okay, so from this I'm going to share with you step by step how to calculate it. So this is a formula that Graham used for the valuation. Okay, so I'm going to share with you what each of these item is about. Okay, the first is the V. Okay, the V here is mean intrinsic value. Okay. And the second one is EPS. The definition is earning per share and the third one is 8.5 is the PE, price to earning. Okay, price to earning for the base for no growth company. So this formula, this 8.5 has been worked out by Graham, and he has done a lot of work to get this 8.5. Okay, so and then we have the G. The G here is the growth rate. For the next 5 years. And then also we have the 4.4 is the average yield. Average yield of AAA, AAA corporate bond. Okay, this is the average yield for the corporate bonds in Graham time. Okay, if you look at today, you can look into the today to see it is changed or not. Yeah, so for today I'm still using this as an example. Okay, and then the Y is the yield curve, current yield curve. Of the current yield of AAA corporate bond. Okay, okay, so these are the formula. Okay, so how we are going, which you are going to use in here? We are going to use Google company to do the valuation on this formula, use to base as a base from Graham from formula. Okay, so we are going into Google Yahoo Finance and we search. Okay, we search for Google. Okay, we already have Google here. Okay, okay, so now we have Google here. Now we have the earning per share here. 12-month trailing is equal to 4.4. Okay, 4.4. 4.4. Okay, the stock is Google. Google, okay. Google, the ticker, okay. You can also do this for any other companies in other countries that and in the public data or in the own data you have in the countries you are applying this, okay. So you have the base PE for no growth, okay. No growth, and you have 8.5. This is a fixed number that been working out by Graham, okay. So he made a lot work and a lot of analysis in order to have this 8.5 P-based earning for no growth company, okay. So we just want apply this for this. He did a very hard work to get this. And then we have the growth rate for the next 5 years for this company, okay, the rate. Okay, we look into to find the growth rate for the next 5 years. We want to see the analysis part, okay. Analysis part to find the growth rate for the company. Okay. Okay, we scroll down and look for the next 5 years growth rate here, okay. Annual predicting growth rate for Google is 15.6, okay. So we have growth rate 15.6, okay. Okay, 15.6. Okay. And then from that, we need to have the 2G, okay. We need 2G, so 2G. So it's just the growth rate time by time 2, okay. So this, so the average yield for AAA corporate bonds at gram time is 4.4, but today is also similar, okay. Or you can look in by yourself to see if it is different, then you replace it with the another number, okay. So the corporate bond of III now, I'm going to look in the current yield on AA corporate bond. So yeah, okay. So we have AAA corporate bond yield at the moment is okay. We need to get the Fed and to see what is today. So it's 4.65 as of today. Okay, 4.65. Okay. So we want to do the valuation for this using the model of Benjamin Graham. Okay. So the valuation, intrinsic value, calculation, we have equal to what? Earning time the 8.5 plus the 2G, and then you time with the current yield corporate, the average yield of IA corporate bond, okay? And after that, you divide by, altogether you divide by the yield, Y yield curve, okay? We get intrinsic value of the Google using the Benjamin Graham methodology is $165. The second most important in the investment decision making that Warren Buffett always talk about is you have to have the margin of safety.
About a margin of safety, that you don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across.
This is one of the videos that he mentioned about it. One of the interview, one of a speech that he has mentioned about it. But throughout its investment life, he has shared this many times, okay? And I'm going to share with you from previous calculation of the intrinsic value to continue with this calculation, how he will calculate the margin of safety, and also from that you can go and apply yourself. What is the price of Google at the moment? The market price of Google at the moment is 122, okay? So it is lower than the intrinsic value that is used by this valuation methodology. We are going to look into the margin of safety area, okay? Because for Warren Buffett, at the market price can be above the intrinsic value, can be below the intrinsic value, because people trade and do investment in many different base besides the valuation and analysis. So there are many people who, when we value the companies in their view, both this intrinsic value, and many people will also sell the company even if it's below this intrinsic value. So you know the definition of intrinsic value. Intrinsic value is the value of real value of the company that is in the fair value in the long term, that is should be trading at that price if it is everyone is rational and look deep analysis into the company. And also, if you use this formula by Graham, then you get the intrinsic value for Google at this price, okay, 165 as of today. However, okay, Warren Buffett also have the margin of safety before he want to invest and makes a decision to invest. So we have the today price of Google is 100, let's see, 122.2, right? 122.2. In that case, you are seeing that the current price is 74%, okay, of the intrinsic value. It's a difference, okay? Difference mean that how much is company is trading compared to the intrinsic value. So if the margin of safety is 60%, okay, it's 60% of the intrinsic value. So what is the board price that you should make the decision when you buy the company? For example, this is Google. So if you we don't have exact numbers that Warren Buffett used for his margin of safety, but I'm assuming that if your margin of safety is 60% of the intrinsic value, okay, then you should time the intrinsic value so if the margin of safety is 60%, and if that means that the price of the stock should be around $99, and it is go $99 and below this, you will buy the company. And if it's go above this, you will keep it until when it go over intrinsic value. So if you are long-term investor, you want is has to be above the margin of safety, like 130%. Then the price of the stocks, okay, get to this valuation, you sell. But if you are on a more shorter term, medium term, you are not just financial investor, you just get to intrinsic value, you sell it. Then the selling price should be same as the intrinsic value. I hope you get something out today from this analysis. You can use this as one of the methodologies for the base analysis before you use other complicated formulas in terms of doing valuation. This is a basic formula that you can apply very quick. If the market price is trading at far below the valuation that use the Graham formula, and after that, if you see that it goes so much discount to the Graham formula, then you can look into an analysis using the other methodologies, okay? But I mean this methodology of analysis and do valuation is more for those who are like looking at the listed stocks, which stocks are more trading in the stock market, and also with the companies that have more data information available, and also the companies that in more mature and growth stage, instead of company in very early stage that have very little earnings, you know.